And so using that past performance, again, it works in other areas of our lives. Sports, it works really well. LeBron James, I always like to say, was a great basketball player for the Cavs. When he went to the Heat, he was a great basketball player. And now that he's with the Lakers, he still is. His performance has persisted. In investing, it just doesn't work that way.
Welcome to Retire Smarter with Kevin Kroski. Find answers to your toughest questions and get educated about the financial world. It's time to retire smarter.
It's another edition of Retire Smarter. Welcome back. Walter Storholt here alongside Kevin Kroski, President and Wealth Advisor at True Wealth Design, serving you throughout Northeast Ohio and Southwest Florida as well. You can find the team online at truewealthdesign.com. Click the Are We Right For You button to schedule a 15-minute call with an experienced advisor on the True Wealth team. Kevin, what's going on in Florida? How are you, sir?
We're doing great. So Florida's good. Again, we're kind of, I don't want to say stuck here, but we made the decision not to travel back to Ohio Memorial Day weekend when we were originally planning, just to not introduce any COVID risk to our family. So we're hunkering down here.
When you say Florida is good, the rest of the country is giving you that side eye, that like, okay, that's an interesting choice of words.
Our home is good. Let's put it that way.
Okay, there you go.
Yes, we are. We have masks. We have N95 masks. I actually just bought some face shields. Got them delivered. Not that I've worn them yet, but we're good. We're doing in Florida this time of year. You gotta, if you're outside, you better be near some water. So we've talked about doing some of the boating, which is coming along. Take the girls over to the pool a lot. My younger one, she's just, our two kids could be more different, but my soon-to-be 2-year-old Cameron. She no fear, none whatsoever. So we were over, there's a splash pad in our community, and she's going down these slides, and there was a couple boys, they were like 4 or so, and the one boy, it was the first time that he had been there, and he was a little scared to go down one of the slides. It's pretty strong jets, and he was scared, and my little nearly 2-year-old just kind of pushes him out of the way, goes down the slide in front of him. So he was feeling a little like, oh man, this little girl just went down. I better go. And then the other 4-year-old boy had been there, he was kind of monkeying around, but he was going down the slide in a way that he shouldn't have, and wasn't exactly safe, and particularly wasn't safe for my 2-year-old. But of course, she wanted to emulate him and was doing so before I could grab her. And so she just did this pretty bad face plant, and I went running in, and she was crying, and I picked her up, and she stopped crying and climbed right back up. So I came back over to sit under the shaded area, which is very much a necessity from the Florida sun. And the 4-year-old's dad said, dude, it's like, your kid is tough. She just went down again. So she's something. But my older one she's an absolute sweetheart. But they're very different for sure. So just really interesting to watch them.
It is. I think that's one of the fascinating things about kids. We were at the beach recently as well over the July 4th holiday, and my cousins have young children, and it was interesting to see. We met one of them for the first time, and she's about 2 now, and the other set of cousins, they're twins, about 4. And so these 2 4-year-olds and this 2-year-old, the 4-year-olds have been to the beach before, and it's been a slow process of getting them like used to the sand, used to the water, very slow process to get them comfortable out there. And the one kid will like pick up his hands after his hands get wet and the sand gets on his hand and it's all caked on it, and he'll cry from like, there's sand on my hands. Like, what do I do? And the 2-year-old sounds a lot like Cameron, just gets out there and she just like runs face first into the waves, and just like they had to like go grab her and like throw a life jacket on her before like they even could blink, and she was just loving it. And so that's how I was as a kid. She and my mom kept saying she's like you when you were a little kid, because there's videos and pictures of me literally just like looking like I'm passed out or dead in the surf as a kid, because I just love the waves just coming and pummeling me, and sand was just getting in every single crevice of your body, that kind of thing. And this 2-year-old was this exact same way. Here her little cousins are scared of it getting a little sand on their hands, and she was just like, just wrecking the whole place everywhere. It was just fascinating to watch. So I love watching those differences play out in kids. Well, glad to hear that you are well. And the face shields, do you intend to use the face? I've only seen one person actually with the face shield out in public at the grocery store, and it was a younger guy, and I said, going with the full face shield, huh? And he said, yeah, Mom won't let me work without it. So
I'm debating a trip. I'm considering a trip back to Ohio just for myself, not for the rest of my family. So N95 mask, face shield, some, you name it. So if I'm going to do it, I at least wanted to be prepared. And so I'm considering it. So it's more of the planning ahead nature that is very, very apropos for my chosen profession.
There you
go. So we'll see, but better to have and not need than need and not have.
That's right. Yeah, it's a great point, and a good thing to leave it on. That's for sure. Well, if you listened to the last episode, you know that part 2 of a conversation we started on the last episode is on the way. We first started talking, Kevin, about this idea of stocks diverging from the economy. The economy, is shaky a little bit in several regards. Lots of bad news out there, yet stocks at the time of this recording, again, have just sort of been trucking along over the last couple of months and recovered from the bottom a lot quicker than expected. But part 2 of this conversation is going to look forward a little bit to say, okay, well, have we gone too far in the other direction? Are we overconfident? And that buzzword, are we now speculating instead of investing? And how do we avoid crossing over that kind of line in the sand, if you will, to use our beach references on the show today? So investing versus speculating kind of being our guiding compass. What do we need to know?
A lot. And I'm actually going to start it with a question. So we've been getting a lot of questions from clients as well as new clients that we're working with and prospective clients that we're talking to, just about, hey, if they have cash, should I invest it? How, when, those kinds of questions. In the last episode, we talked about how many of our clients, we advised that they increased risk, and that has certainly paid off pretty well, even though it wasn't necessarily a timing decision. And some of the questions they're asking now as well, does it make sense to stay here? Do we take that risk off the table? All of this. But so I was reading, it was an Institutional Investor magazine, and it was a survey that was conducted by readers of Institutional Investor magazine. So obviously, as the name implies, these are professional investors. It could be people like me, but it could also be pension funds, could be people that manage college endowments. Tends to be more on the institutional side and not necessarily, they would call people like me more so on the retail side, working with, Joe and Jane consumer that are planning for retirement. So these are definitely a little bit more of, I guess you would call it the big boys in the pension fund world and endowments and things like that. And the question that was posed was this: are markets factoring in the long-term impact of the coronavirus appropriately, too much, or too little? So let me read it again. So are markets factoring in the long-term impact of the coronavirus appropriately, too much, or too little? And Walter, I did not share this with you in advance, so pretend you are an institutional investor for a moment. Actually, just give me your own opinion. Don't even pretend you're an institutional investor. So what do you think? Is it, if you think of equity markets, is it too little? Is it appropriate, or is it too much?
I would say too little. I feel like we're not going to recover economically as fast as we would like or predict. So I think maybe we have over rebounded. That would just be sort of my initial gut, uneducated opinion.
Okay. So you fall in with the 65% of institutional investors in terms of the too little category. So you're in the majority there. So 65%.
It's not usually good to be in the majority. Well, I'm nervous.
Well, you're in the institution. You're a big boy now, Walter. You're an institutional investor. So you're within that crowd. So kudos to you in that regard. But that's what they believe.
I always strive to be institutionalized.
Well, good job. Now you can share with your wife that you officially are. 65%. Only 5% said too much. 30% were, hey, it's appropriate. And then 65% said it was too little. So again, it was the long-term impact of the coronavirus that our market's factoring in. So interesting that you mentioned that the economy was not going to rebound as quickly, which in the last episode, we talked about how the economy and the markets aren't exactly the same thing. So I won't kind of dig too much deeper on that, but it was just interesting that you chose the word the economy,
right?
When the question was, are markets factoring in the long-term impact of the coronavirus?
It shows how ingrained it is into us, even though we just had a conversation about how it's okay that they diverge. Isn't that interesting?
Yes, and the other thing too, when you think of what came to your mind, like our markets. So markets is a very broad term. What came to your mind when I asked that question?
Jobs, kind of like flashed in my brain. And then, honestly, when you say the markets, this is kind of interesting. I think of, and maybe this is just because of the pandemic, but I think of shops and stores and employment are buildings full of people. And so I think with everybody working from home and potentially that being long term, that's just sticking in my mind of like, we're not going to see places as full as they used to be. I also feel like commercial real estate is going to take such a huge hit that's going to create major problems down the road. That's sort of the third component bouncing around in my mind.
I agree with you, and we've heard a lot of that in the conversations that we've been having with clients and new clients. The other thing that I think a lot of people, where their mind goes when they say markets, is just what they see on the nightly news every night. Hey, the NASDAQ did this, the S&P did that, and that's certainly a big part of the U.S. market, and the U.S. is about half of the world market. But as we've talked about in prior episodes as well, with some of the technology, the big, large cap technology companies, they're more than 20%, nearly 25% of the S&P 500. The NASDAQ is almost entirely technology-based companies. And so it's really maybe not fully the wide swath of sectors, because many sectors are underrepresented, like real estate that you mentioned, energy. Certainly used to be a much bigger component. Now it's a lot less. Industrial companies, things like that. I mean, the technology companies have become bigger and a bigger part of our economy, but also they've become an even bigger part of the market just because of their outperformance. And so, and we're not even talking about other countries. I guarantee you, whenever people listen to this, and if they think back on when I asked that question and I said, are markets factoring in, they probably thought about the same sort of things that you thought about, or they thought about, again, the stuff that they see on the nightly news. They didn't think about, well, let me think about how Europe is done, or Japan, or China. And are those markets down more or less than the US? They didn't go there. You're listening to this in the US. And if we have some listeners outside of the US, maybe they went to the country that they're in. But that's kind of what we're conditioned to think about. And if you look at the sectors in general, for the first half of the year, so through 2020 through June 30, through the first half of the year, 7 of the 11 sectors, basically sectors, and then you can break down sectors into certain industries, but 7 of the 11 broad sectors were negative for the year. If I do a little bit of adjusting there and I say, hey, Amazon, you're really more of a technology company, which is probably what most people think about when they think about Amazon. But technically they're in a consumer cyclical sector is where they're classified, which is debatable. And then you think about like Google and Facebook, which are also some of these big tech companies that have done really, really well. Certainly technology companies, but they fall in the communication services sector. So if I just set those 3 companies aside from those sectors, then 9 of the 11 sectors in the U.S. are down. Again, technology is up. Basically, everything else is down. Walter, you want to take a guess at what the other sector that's positive on the year, slightly positive?
What's that?
Take a guess. It's. I'll give you a hint. It's close to home.
Financials.
Think about your wife.
Healthcare. Sorry,
yeah. So healthcare is slightly positive.
Close to my home. Gotcha.
Close to, yeah. So the broad swath of the economy is down. It's really, again, the technology companies, we've talked about this in the past, but that's really, what's been up. If you go down to small companies in the U.S., let me back up for a moment. Large companies in general, like the S&P 500, comprises about 75% of the U.S. market. And again, the U.S. market is roughly about, half of the world or so in terms of the investable universe. So small companies in the U.S. comprise about 10% of the U.S. market. Small companies are down, 13%. If you go into small value companies, they were down 24% through the first half of the year. If you go outside of the U.S. Into developed markets, and in dollar terms, developed markets, Europe, Japan, Australia. I mean, they were down about 11% collectively. And then emerging markets, think China, Taiwan, South Korea, India, Latin America to a much smaller extent. They were down about 10%. So really, our markets, if I go back to the survey question in Institutional Investor Magazine, are markets factoring in long-term impact of the coronavirus appropriately, too much or too little? If I'm going to be nitpicky here, I would say maybe the question wasn't all that great. Markets is a very, very broad term. And even though this is Institutional Investor Magazine and these are, educated professional investors, I guarantee you their mind went to a similar place where yours went, Walter, or towards these large US-based indices, probably to a lesser extent than yours or people that are listening to the show. But that's where it went to. It's just a home country bias that they tend to have. So it really kind of depends what markets we're talking about. So I think that's an important point to make. But let's just say that we are talking about maybe the more expensive parts of the market. So the NASDAQ through the first half of the year, again, almost all technology-based kind of companies is up 13%. Or if we look at specific companies that are in there, if you look at, say, Amazon's about 135 times earnings. Zoom, Walter, we're talking at least in part through Zoom right now. And PE ratio, so price to earnings ratio, is just a way to value companies. Want to take a guess what Zoom's price to earnings ratio is?
Ooh, I'm just going to say good.
Well, I would say rephrase that and say high.
Good.
So people listening has probably never heard of Zoom before the COVID situation. And if you look back kind of on their trailing earnings, they're 1,400 times. Their price is 1,400 times their trailing earnings. And their forward earnings, given some estimates that analysts makes, it's still 208 times their forward-looking earnings. Comparatively, let's just talk about the S&P 500, for example. If we go back in time to the last 25 years, the S&P 500 trades about 16 times forward-looking earnings. So let me pause there for a moment. So 16 times versus 135 times for Amazon, more than 200 times for Zoom. That's pretty high price, pretty nosebleed territory. Got to have a super ton of growth to even come close to going ahead and justifying paying those nosebleed kind of prices. But even if we look at the more broad-based S&P 500, so again, it's become more tech-based. It's more than 20-25% just between the five big technology companies with Facebook, Apple, Amazon, Microsoft, and Google. But even the S&P 500 is trading at 21 times its forward-looking earnings right now. So that's basically about, a 24-25% above its 25-year average. So has it come too far too fast? Again, I think those are some of the things that were in the mind of these institutional investors when they were surveyed. It certainly seems like that has been the case, particularly for some of these popular stocks that have come through COVID. Frankly, only time will tell. But you're seeing a lot of this sort of euphoria in these certain names, and day trading was pretty prevalent in the .com era. You're seeing a lot of that again today. A lot of millennials you're seeing news reports. Unfortunately, there was a sad story a couple weeks ago. A millennial was doing some day trading. He logged into his account through a platform called Robinhood, and basically he was using some options which have leverage to them. And what he saw was, I think he owed he was negative $700,000 or $750,000, and that did not go very well in terms of his mental processing, and unfortunately he ended up taking his life. And his suicide note at least somewhat blamed this Robinhood investing platform. So you're hearing stories like this, and there's a lot of evidence to show that there's a lot of this sort of day trading that's going on. And of course it's in these popular stocks that people have become more accustomed to, that are garnering the attention, that have gone up a lot in price. So I think it certainly seems reasonable that a lot of the looking forward part that we talked about, which I think is appropriate when you look at the stock market, it certainly seems like certain parts have extended to beyond the prudent looking forward and going into more of the speculative category.
It's interesting to hear that kind of I don't know. That perspective is really hard to wrap your head around, and you're right. How you define the market really does impact your perspective on it all. Whether you have a more global view or country-specific view, how closely you tie the economy into this conversation of the stock market, and then just your personal situation, right, Kevin? I mean, as a 30-something versus somebody who's entering into retirement, your view of maybe what speculation is or how much tolerance you have. It's not just a risk thing, right? But it's just sort of, it's a little bit more involved than even just the risk conversation as we get into this sort of speculating versus following true, good proven financial principles that you like to put in place. You've got to take into account your own feelings and situation on the subject.
Well, I think you're kind of getting to an area that it makes sense to talk about when you talk about emotions and maybe why some of this is happening. So let me maybe weave in a little story here that maybe is at least in part a bit humorous. So I was born in '76. I remember watching The Simpsons when it first aired in the late '80s for a Christmas special, and I was basically hooked on The Simpsons after that and watched a ton of reruns of it throughout my college years. And when I read this survey article from Institutional Investor magazine, it made me think of something I remember Homer saying that related to investing. And what Homer said was, he said, "This year I invested in pumpkins. They've been going up the whole month of October, and I got a feeling they're only going to peak right around January. Then bang, that's when I'll cash in." And so Homer here is looking at the prices of pumpkins continue to go up throughout October. Obviously we know what holiday is at the end of October, and the pumpkins are pretty prevalent around that time period. And he's just looking at recent past prices and projecting them forward. Or maybe we would go to the next month and think of the month of November. Walter, what kind of food do you think of when you think of the month of November?
Sweet potatoes. No, turkey.
Sweet potato. Right, thank you. Yeah, sweet potatoes are inanimate objects, so turkey's much better. Thank you. You didn't ruin my story.
I was already going to the cooked side.
So think about the life of the turkey. The turkey, and I don't know, I've never been to a turkey farm, but the turkeys are getting fed every day by these humans, maybe by some robotic equipment. I'm not sure, but they're getting fatter and fatter, and they're like, "Hey man, this is a pretty good life. Yeah, I'm stuck in here with a bunch of other birds, but I'm getting fed. I'm happy. Life is good." And then they keep believing that all the way up until, I don't know, late October, early November. And then something pretty drastic happens in the turkey's life. What happens, Walter?
They are killed. I was going to go with a more colorful description, but we'll keep it basic.
The turkey's life changes, not necessarily for their good, maybe for our good, if you're not a vegetarian, I suppose. But, it's kind of another example where, things continue in a line for a while until it changes. And in the case of turkeys, it changes quite dramatically. In the case of the pumpkin prices, again, it changes quite dramatically. And
it's interesting. You could play that out. Every month has something, right? I mean, we just had July 4th recently, so the price of fireworks, is always ramping up right before the July 4th. I mean, I've been to shop for fireworks on the 3rd, and it's extremely expensive. And I've been to shop for fireworks on the 5th, and you can buy the whole place for $20. You know what I mean?
Right. So some of these, obviously with turkeys or fireworks or Christmas decorations, we kind of know when these times are when things are going to be really different. You don't have that clarity with stock prices, but sometimes you're
the turkey and you don't know how it ends.
Yes. And there's actually, it's our brains that kind of do this. So if you think of investor psychology, our brains just work and they take very shortcuts that tend to serve us pretty well in many areas of our lives, but it tends to set us up to make some pretty common and repeatable investing mistakes. Using past performance, like, hey, pumpkin prices increasing or whatever it may be, is one of those. In fact, there was a 2011 study. It was at one of the big national discount brokers like Schwab, Fidelity. And these researchers looked at all the trading decisions for a bunch of DIY investors. And wouldn't you know it, that they found that the investment purchases that they had made had outperformed the market over the prior 2 years prior to their purchase by 40%. So it's not like they bought the things that were out of favor. Then like, okay, hey, the price got a lot cheaper. They're like, no, hey man, this thing has gone up 40% over the last 2 years on average. I'm going to go ahead and buy this because it has done really well. And then what they found, the researchers found, was that the thing that they sold to free up the cash to buy what they bought that had recently done well, if they wouldn't have done anything, if they just held on to the investments, they would have actually been better off and had more money. And so using that past performance, again, it works in other areas of our lives. Sports, it works really well. LeBron James, I always like to say, was a great basketball player for the Cavs. When he went to the Heat, he was a great basketball player. And now that he's with the Lakers, he still is. His performance has persisted. In investing, it just doesn't work that way. The other thing that I think really comes into play here, and so just to make sure I actually draw the line back to what we were talking about. So these stocks that have done really well, particularly, Zoom, Amazon, many, many others that are like that. And within, generally speaking, the technology or the biotech space, there's kind of, hey, we're looking at it, it's going up, so it's going to continue to go up. So we're just going to go ahead and pile on. That's speculating. That's, you have to find kind of the greater fool to go ahead and willing to pay the higher price than you, because when the price becomes detached from the fundamental valuation, then, eventually the music's going to run out and people are going to be looking for chairs. If you think about something else that people do, Walter, you're a millennial. I won't say pick on you for a moment, but what is FOMO?
Fear of missing out.
Yes. And so FOMO, I think, was kind of coined maybe 20 years ago or so, but it's really, I think, been exacerbated by a lot of these social platforms like Facebook and what have you. And it's easy to share information. What are people doing? Oh, they're having fun. I want to have fun too. Oh, they're making money in the stock market by buying Zoom. I'm going to do that too. And a lot of the technology makes it so much easier. So FOMO is there, but even kind of related to that, if we think back a little bit longer term, more of like a herd mentality. It served us really well when we were like in travel times before our culture was industrialized and we had pretty harsh conditions that we had to deal with. Well, hey, maybe we were going to get hunted. We had to find food, hunt and gather. We really needed to go ahead and have that herd and foster cooperation within the groups. But today, certainly we don't have that sort of harsh, I would say nothing like those harsh conditions, but we still have that sort of a similar brain, and that our brain functions in a way that was ingrained over many, many, many years to go ahead and get us where we are today. But these shortcuts that it takes, or these behaviors that it's kind of has ingrained to it, like the herd mentality, or maybe the modern day version of it in FOMO, doesn't really serve us well. And I think it's probably contributing to a lot of the euphoria that you're seeing in certain pockets of the market. There's other kind of things that the mind does, again, that maybe work pretty well in the past or in other areas of our lives, but doesn't necessarily work so well investing. But whenever you're buying something for several hundred times earnings, and just think that for a minute. If you're buying something for 10 times earnings, just doing simple math, basically, whatever you buy today, you're going to get paid back over a 10-year time period. You can kind of simplistically think of it that way. If you're buying Zoom for 200 times earnings, well, I don't know about you, Walter. Maybe I hope I live 200 years. Maybe I don't, depending on what the quality of those years looks like, right, and what sort of innovations we have. And if I have enough resources to live that long, quite frankly, after I'm done working, whatever that may be. But
your brain will live in the cloud for 200 years. We don't
Zoom better keep zooming in terms of their earnings if anybody's going to make any money on this stock, unless they're going to find that greater fool, is what I'm saying. There's a lot of that's going on. So again, we started talking about markets. I think the question was kind of poorly phrased, but these were institutional investors that answered this, and 2/3 of them think that basically the market is factoring in the long-term impact too little. So just as you believe, Walter. So I think you do have to look through that a little bit. I don't think it was a perfectly worded question. You have to look to these earnings. And again, nobody really knows right now. Probably about half of the companies that usually do provide earnings estimates are not doing so right now, just because they're saying, look, we don't know. The last quarter was pretty crazy. And so because we don't know, we're not going to provide any guidance. But I think as we're in July now, people are going to be reporting Q2 earnings. I think they're going to have to start providing some more guidance. And I think we're going to start having some more clarity on really what we can expect, but there's still a ton of uncertainty because who knows exactly how the pandemic is going to continue to manifest. Is it going to come under control? It's probably going to continue to vary both over time and over states and countries until we do get that widely distributed vaccine. So there's a lot of wide-ranging outcomes that we can have now. So even though that we're going to be getting earnings estimates, I mean, you got to take some of this with a grain of salt. So what does that mean? I guess maybe let's kind of bring this home. What do we do as investors? Well, it's the thing that we should always do. First and foremost, you need to have a financial plan. If you're in retirement, you need to make sure that you know where your income's coming from and how that's going to be derived. The shorter term money that you're going to need should be in shorter term, very high quality assets, cash, high quality bonds, so on and so forth. If you look out longer term, there's certain parts of the market that are still marked down, quite a bit. And as long as those companies stay in business, it's likely that you're going to see a big rebound in prices in certain parts of the market as a lot of this uncertainty does go away, and we do work through this over the next 1, 2, 3 years, whatever it may be. Hopefully it's not longer than that. But you need to be starting with a plan. The investments need to be aligned, to your plan, making sure you're taking the appropriate amount of risk. Again, if you can be a little bit more opportunistic, if you have the ability to do that, then we could look at that. But you have to start with a plan. Nothing is done in a vacuum here. And then, this wasn't in a Simpsons episode, but it was a Nobel Prize winner that said diversification is the only free lunch in investing. So all of those different sectors and countries that I briefly mentioned as we went through the episode today, frankly, we should own all of that to varying degrees. We may want to overweight some assets rather than others. We may not want to completely, go away from some of these technology companies that are expensive, but we may want to go ahead and prune our allocation to it a little bit and put it into some of the things that haven't participated as much and frankly are a lot cheaper. But Homer would probably say, hey, I like the concept of free lunch, and for Homer, maybe diversification means, I don't know, beer and donuts. But we need to think a little bit more than that and do a little bit more analysis in terms of what that needs to be. The final thing I will say is, and I think I mentioned this in the last episode, but Vanguard came out with a report recently saying that 90% of their investors, their accounts, have made no changes this year. And that may sound good on surface. That's great that they did not panic out in March and were able to get the rebound. However, they didn't change their allocation. Maybe some of them should have been raising more cash because they are in retirement and things are more uncertain, or maybe they're in a higher risk business and maybe their job is more prone to not being around and they need to change their financial plan and thus have some changes made in their investment plan. They didn't rebalance in March after stock prices had gone down 30, 40, 50% in some cases. They didn't sell the bonds that had held up in value and buy the things that have fallen in price. That's a big mistake. They lost out on a lot of return and a lot of dollars there. For the taxable investors, they didn't realize tax losses that they could have realized in March and completely avoided or really mitigated income taxes that they're going to have to pay this year on their investments and probably next year and the year after. These are all things that need to be done. The process for planning as well as for investing is dynamic, and the inputs to that process have been changing in very quick order this year. And while there's a lot of uncertainty around some of these inputs, nonetheless, certainly some things are becoming much, much more expensive. Other things are not. All that needs to be factored in and adjusted accordingly, and it's going to be ongoing. And so as we get new information, again, the process stays the same. The inputs are changing, and as certainty around those inputs increases, then you're going to be able to take more conviction in making a decision whether to overweight or underweight, own more stocks, own less stocks, whatever it may be. But the do nothing approach is really falls short, and certainly having the bad behavior approach, whether you're like Homer and just chasing pumpkin prices, or maybe like some people just zooming on the Zoom price or other technology stocks, or on the other opposite side of the coin, if you were panicking out, neither of those is really a good investing decision. That's where you get into speculation, and that's no way to invest your hard-earned money or your life savings.
And too often we're making these decisions in a vacuum and not considering how it impacts our overall financial landscape, our overall financial plan, our future, everything that is to come, you have to take into account all of those things. You can't just say this is one good opportunity and isolate everything else, or at least you can't. It doesn't seem like you can do that very often from what I've learned from you, Kevin. You've got to keep it all in perspective and all in focus and in the picture. And so if you have had any trouble doing that yourself, making sure that you're making wise financial decisions, looking to be proactive and not just following the herd, that herd mentality anymore, reach out to Kevin and the team. You can schedule a 15-minute call with an experienced financial advisor on the True Wealth team by going to truewealthdesign.com and clicking on the Are We Right For You button to schedule your call. That's truewealthdesign.com and click on the Are We Right For You button, or give a call to 855-TWD-PLAN. That's 855-893-7526. Kevin, we don't want the herd mentality to turn into lemmings following one another off the cliff in the financial landscape. So we look for good leaders. We look for people who are proactive in this space. Something that I think it misses, is missing from this space many times. But I appreciate your perspective and your guidance, your ability to look forward, to put things into perspective, and to challenge the norm, and making us all a little bit smarter when it comes to retirement today. So thank you.
Well, I do my best, and I appreciate you saying that, Walter, and hope it's helpful for the people that are listening.
Absolutely. Well, we'll look forward to talking to you again on the next episode, Kevin, and thanks to our listeners for tuning in today as well. Don't hesitate to reach out if you ever have any questions at all. For Kevin, I'm Walter. We'll talk to you next time, right back here on Retire Smarter.
Information provided is for informational purposes only and does not constitute investment, tax, or legal advice. Information is obtained from sources that are deemed to be reliable, but their accurateness and completeness cannot be guaranteed. All performance reference is historical and not an indication of future results. Benchmark indices are hypothetical and do not include any investment fees.